3 months ago, oil was falling. Inflation was cooling. Markets were celebrating. Then, in just a few days, oil crossed $100 a barrel again. So what happened? And why does it matter, even if you don't own a single barrel of oil? Part 1. Why did oil suddenly cross $100? To understand this, you actually have to go back to February. That's when the US and Israel launched joint strikes on Iran. The war that followed didn't stay contained to missiles and airstrikes. Iran's response was to choke the Strait of Hormuz. That's the narrow waterway between Iran and Oman. Roughly 20% of the world's oil physically passes through it every single day. Before the war, about 138 ships crossed that strait daily. At the worst point, that number dropped to single digits. Brent crude, the global benchmark, spiked as high as $138 a barrel at one point in April. Then for a while things calmed down. A ceasefire held. Oil drifted back down into the 70s and 80s. By late June, airline stocks were actually rallying because jet fuel had dropped 30%. Everyone exhaled. Here's the twist. On July 8th, the ceasefire ended. Oil jumped again. And then, on July 23rd, it got worse. The crisis found a second front. Saudi Arabia had been quietly rerouting its oil exports around the closed Strait of Hormuz. Tankers were going through the Red Sea instead, through a narrow choke point called the Bab el-Mandeb Strait. That workaround was the thing keeping global supply from truly breaking. On July 23rd, Houthi rebels in Yemen, backed by Iran, attacked 2 Saudi oil tankers in that exact strait. One of them caught fire. The Houthis then declared a full naval blockade on Saudi shipments through that corridor. Brent crude jumped nearly 7% in a single session. It crossed $100 a barrel for the first time since May. Since the start of that month, oil prices had risen about 35%. Makes sense why this specific spot on the map matters so much. About 12 to 15% of all global maritime trade passes through that one strait. That's worth more than $1 trillion a year. Block Hormuz, and Saudi Arabia has a workaround. Threaten the workaround too, and there's nowhere left to reroute to. That's the supply shock in one sentence. 2 choke points, both compromised, at the same time. Part 2. Why is oil always this sensitive to war? You might be thinking, okay, wars happen all the time. Why does oil specifically freak out every time one touches the Middle East? Here's the thing about oil that makes it different from almost every other commodity. It's not really about how much oil exists in the ground. It's about how much can physically move on any given day through a small number of narrow waterways. Roughly a fifth of the entire world's oil supply funnels through the Strait of Hormuz specifically. At its narrowest point, that strait is only about 21 miles wide. There is no easy substitute route for most of that volume. Tankers can't just fly over it. They can't take a scenic detour without adding weeks and enormous cost. So when a government or a militia threatens to physically interrupt that flow, traders don't wait around to see if it actually happens. They price in the risk immediately. Oil markets move on expectations of future supply, not just today's barrel count. Goldman Sachs analysts describe the current disruption to Persian Gulf exports as the largest supply shock on record. Larger even than the 1973 OPEC embargo. Larger than the 1990 Gulf War, at least in terms of its immediate hit to flows. That's not a small comparison to make. And it explains why a single tanker fire off the coast of Saudi Arabia can move markets more than most entire quarters of economic data. Part 3. Why did stocks fall right along with it? This is the part that surprises people who don't follow oil closely. You'd think, okay, oil companies go up when oil prices go up. That's simple. But watch what happens to everyone else. Airlines get hit first and hardest. Jet fuel is typically their second biggest expense after labor. Oil spiked toward $100 back in March. The big 3 U.S. carriers, Delta, United, and American, saw their market values evaporate within hours of the opening bell. United CEO Scott Kirby, not known for mincing words, warned directly of a meaningful impact on the business. Then there's shipping and logistics. Every container, every truck, every delivery van runs on fuel. Transportation costs ripple through the price of literally everything that gets moved anywhere. Then there's inflation itself. In May, U.S. consumer prices rose 4.2% year over year. That's the highest reading since 2023. More than half of that monthly increase was tied directly to energy costs. War-driven energy costs alone were up nearly 24% year over year. And that inflation number puts the Federal Reserve in a genuinely uncomfortable spot. Higher oil prices push inflation up and growth down at the same time. That's exactly the combination a central bank has no clean tool for. Cut interest rates, and you risk pouring fuel on an inflation fire that's already burning hotter because of energy costs. Hold rates steady, and you risk tipping an already slowing economy into a recession. Goldman Sachs raised its 12-month U.S. recession probability to 30% because of this exact bind. That's up from 20% before the war even started. So when oil spikes, it's not really an energy sector story. It's an airline story. It's a shipping story. It's an inflation story. And it's a Federal Reserve story, all at the same time, all tied back to the same barrel. Part 4. Is $120 actually possible? Short answer, multiple major banks think so. Some think it could go higher still. Goldman Sachs has laid out a scenario with sustained production losses near 2 million barrels per day. Under that scenario, Brent could push into the $115 to $120 range by the end of this year. One of Goldman's own commodities researchers, Don Streven, said publicly that $120 by year's end is now the bank's forecast. Not just a worst-case scenario. And Goldman's own worst-case modeling earlier this year put a ceiling on how bad things could get. $145 a barrel at the peak. $120 sustained through the end of the year. A level that could push U.S. gas prices above $5 a gallon for the first time since June 2022. Here's the detail that actually matters most, though. Saudi Arabia and its OPEC plus allies do have spare production capacity sitting idle. They've been adding modest amounts of supply back into the market, roughly 200,000 to 400,000 barrels per day at a time. But that spare capacity doesn't solve the actual problem. The problem isn't that there's not enough oil being pumped. It's that ships physically cannot move it through a blocked or threatened strait. No amount of extra production fixes a tanker that can't safely sail. Goldman's blunt framing of all this was that, right now, $100 isn't a ceiling on oil prices. It's the floor. Part 5. Why is this time more dangerous than past oil shocks? Here's where this connects to something that has nothing to do with Iran, Yemen, or Saudi Arabia at all. AI. Data centers across the U.S. now need enormous, constant amounts of electricity. A huge share of the new power plants being built to supply them aren't solar or wind. They're natural gas. The share of new U.S. power projects planned as natural gas has jumped from roughly 11% in 2024 to over 18% in 2026. Non-renewable capacity additions have surged 71% in just the last year, largely to keep AI data centers running around the clock. Data center developers alone have already announced about 101 gigawatts of on-site natural gas generation, specifically to bypass the years-long wait for grid connections. Now here's why that matters for oil. Natural gas and oil often come out of the same wells, especially in basins like the Permian in West Texas. Higher oil prices actually incentivize more drilling. That produces more natural gas as a byproduct, which should, in theory, keep gas prices in check. But AI data center demand for electricity is growing so fast that it's creating something new. Analysts call it a persistent new demand floor underneath natural gas prices, one that didn't exist during any previous oil shock in history, which means the U.S. now has two enormous, fast-growing sources of energy demand competing for the same infrastructure. At the exact moment, A war is choking off the supply of the world's other primary energy source. Every previous oil shock in modern history, 1973, 1990, 2008, hit an economy that wasn't simultaneously trying to build out hundreds of gigawatts of new electricity capacity for artificial intelligence. This one is, and that overlapping demand keeps energy costs elevated even after a war eventually ends. Because the AI build-out isn't slowing down just because oil tankers start moving again. So there are two ways this plays out from here. Either the Hormuz and Red Sea situations de-escalate and tanker traffic normalizes, oil drifts back down toward the 70s and 80s, the way it did back in June. Or the standoff drags on, and OPEC+'s spare capacity gets tested past its limits. $120 stops being Goldman's forecast and starts being the new normal. Right as AI's own energy appetite adds a second, structural source of pressure underneath it. Oil isn't just another commodity. It's the price of moving the world. And when oil rises, almost everything follows.